Good evening and welcome to this evening's presentation. This is the third time that it's been in this format, which is as a webinar, a direct replacement for what we would normally do in the British Club in Bangkok. At some point we will be back, but I think, as I've mentioned before on the last one of these, we don't know when that will be, and with the situation changing and developing as it is, it's hard to say when we'll actually be back physically. We'll have to wait and see, but as soon as that is possible, we will be back and look forward to seeing you in the club personally. So a few things to mention. We sort of thank the club as well for our continuing involvement with them. We are into the sort of third year of this, and it's been a delight to be involved. It's just a shame we can't be there to be involved more physically, but that will come back around. But again, thanks to the club. Something to mention as well, if those, I've seen the sort of attendee list, and there are a number of British Club members there, but it's important to say as well that we also do produce publications within the Outpost magazine. There's a couple of articles in there every month. We have 2 pages. So I would say have a look through the website, because you don't need to be a member to see what we actually write in there. We try to keep them useful and informative, and please feel free to have a look, but these do come out every month, a couple of pages in the Outpost magazine for the club. So a few things to mention for this evening before we start properly. We will finish on time, and hope that is at 7:30 in Bangkok time. So that's the plan. And what we do is we keep the mics and cameras closed off just to make a smoother event. We've found over time that works better. Please feel free to ask some questions, and because of the format of the way this works, you should see a Q&A box, and please feel free to type your questions in there, and we'll get through as many as we can at the end. And like these things, we are reliant on technology to work well, and hopefully that will be the case, but apologies in advance if there are any slight slip-ups or any hold-ups. We'll try to move things on as we can quite smoothly. Now, I've met a number of you before. As I say, I've seen the attendee list, and I do have some sort of relationships with a few of you. It's been some time now. We've been dealing with people in Thailand, and as a result, I've been dealing with people there for the best part of 14 years now. So I've been with the Fry Group for the same period of time, 14 years, and hopefully the same sort of time again in the future. So I'll be doing a couple of subjects tonight. I will then pass on to associate Max from Schroders, who will talk about the investment markets. And we hope you find these useful, and perhaps even in the question box, if you've got any particular subjects that you'd like us to cover in future events, maybe drop us a line and we'll see what we can do to include those. So a bit more about us, if you don't know exactly what we do and who we are, but the heritage of the company, it's over 120 years old. We've been in Singapore for 20 plus years, and much the same time in Hong Kong. We do have offices in other locations, primarily the UK, where we have 4 different offices, also Belgium, Singapore, of course, and Hong Kong, and Dubai is the most recent, added to that list as well within the last couple of years. The key to the company is we have 3 parts to the group. We are a tax advisory practice. There is an executor and trustee company as well, which looks at UK wills and trusts and estate planning, as well as the part that I directly work for, which is the financial planning section. We are designed to provide advice, particularly sort of UK tax advice and anything else that involves on the financial side. We can't provide tax advice locally in the other countries where we do work, but we would normally have a contact or know of a company that can. We've also have an arrangement with a fairly big accountancy firm as well. This is, if you like, the mission statement of what we are as a company. There's different variations on a theme here, and everyone may have their own view about what they feel and what they think is financial freedom to themselves. But that's the plan behind the company, is to adopt and entail, one would think, across the board, to try and make things as amiable as possible. And if that's tax, if that's on the estate planning side or financial planning, we try to bolt those things together to make a smooth approach for our clients. You would have seen the agenda. You've seen an ad somewhere, whether that's on the database that we've been sending around or through the British Club. This is what we'll be looking at tonight. So we'll be looking at some of the considerations for retirement. I think it's pretty safe to say that a good number of our clients in Thailand, in Bangkok, in particular, are already retired. So we will be looking at the effects and considerations on retirement income, particularly sort of UK pension income, and in advance for those that are still employed, something to consider, albeit there are less tax efficient options, I guess, available in most other countries. We're then looking at the different methods of holding investments, and this is something quite new that we're producing this time around. And then, as I say, I will hand over to my associate Max, who will be looking at the investment markets and some of the main considerations for the moment and perhaps into the later part of the year as well. So first things first, as I mentioned, we're looking at retirement planning and UK pension income, primarily because we deal with Brits more than any other nationality around the world and where we work. So as a result, we try to cover what we think is most relevant. I mentioned this, that there are a number of people that are still employed that we actually work with as well, although it's few and far between in comparison to the retirees that form the basis of most of our clients. So you may or may not be aware of this, and it warrants a mention because we did actually look at this for an individual within the last few months or so. We've actually done this a couple of times now for employed people. It's a bit like a company pension in the UK in that the recent company pensions in the UK are investment related. They're normally collective pensions within a group, and it's very similar to that. Why we mention it is that as an employee, it's going to be almost compulsory. It almost leans on the compulsory nature of joining pensions in the UK to make employee contributions with an employer payment as well. And it is tax efficient for those that are still employed. It does warrant consideration because of literally the tax exemption and the tax freedom. And when I looked at this for this individual, it was surprising to see there was a good strong range of investment options within the plans, and also they were quite cost efficient and quite cheap, surprisingly so, almost in line with what we're seeing in the UK. So it does warrant consideration for one that's employed because of the tax advantages in particular. So I won't cover too much on that, but I will say that if we do get requests on this, we can look at these things. We can't provide advice on local propositions, but we can look at these things, and we were able to help this individual more with investment choices than anything else. So anyone that's had employment in the UK or has paid voluntary contributions will have some entitlement to the UK state pension, and the current rates are as shown there on the screen. There are two different types of state pension, one for those prior to April 2016, and a maximum level is shown there, and a current level for the full state pension is a little bit higher. Now, with most Brits having built up some form of state pension over the years, we would normally suggest this also because it does form the first thing that's taxable under the UK that's put against the UK personal allowance. The current personal allowance is the rate shown below, and I've yet to see most of the sort of the personal allowances used up by, certainly from a state pension perspective. It's going to really max out at just under sort of £9,500 a year, but it does eat up the first part of the personal allowance, which we, and I say collectively we are entitled to still as non-UK residents. Now, whether that remains in the future is hard to say. There has been some murmurs over the years that may be reduced or removed altogether for non-UK residents, but we will wait and see because it still stands at the moment. And if that was to be removed, there's an instant tax liability, but even on the state pension itself. So we will wait and see. But as it stands at the moment, it sits within the personal allowance, which means it is a tax efficient stream of income. You probably know, and if you are in receipt of state pension, it can be paid to you anywhere in the world. But this is one thing that is applicable to Thailand, and I'm sure you are aware of this. There has been some lobbying about this to the UK government from those resident in Thailand, so far unsuccessfully, in that there are no state pension increases to basic state pension in payment for a resident of Thailand. So whether that remains the case in the future will be based on the government decisions, and it's hard to say what that may determine, but so far there has been lots of lobbying unsuccessfully. So if you are in receipt of state pension, it will remain at the same level. Now, around the region, I may have mentioned this to you before if you've been part of the presentations that we've done. Oddly enough, the Philippines is the only country around the region where there are state pension increases, and that's because of this bilateral social security agreement between the UK and the Philippines. Otherwise, it's normally those countries in the EEA, Gibraltar or Switzerland, or specific countries which do have those agreements in place. So other than that, we can say for the foreseeable future, at least, the state pension will remain level in payment. Now, you may have heard this talk about triple lock guarantee. It was introduced a decade or so ago now, but it was very effective when it was introduced, because what that meant was it was the highest of a specific percentage, 2.5%, the growth in UK earnings, or CPI, the Consumer Price Index, as the inflation measurement. So it was very effective because it actually meant the increases were at quite a strong level, albeit for those in the UK or those qualifying countries. Now, this is also warrants a mention, and oddly enough, this really came to light. We were dealing with one of the British Club members a few years ago, and he'd been looking into this himself and said, look, he'd been in touch with the Future Pension Centre. There's a number there below, but you'll be able to find this information on the internet. A prolonged period of stay in the UK, and albeit that's hard to determine at the moment, where just getting into the UK without quarantine is difficult, and getting back to Thailand. But those longer periods, those longer trips in the UK, it's possible to ask for the state pension increase to be applied for that period. And these backdated increases also do apply. But it must be done 1 month in advance, and it's done directly. But it was surprising because it was probably the first occasion we'd actually had that conversation with somebody about this, and they'd done their research and their homework and been in touch with the Future Pension Centre, and it was surprisingly easy for them to apply this extra increase. So worthwhile if there is a longer trip, but of course these things at the moment are difficult to ascertain because we just don't know how this is going to develop. But certainly what seems to be the case is that the UK seems to be improving at quite a rapid rate, mostly because of the vaccination programme. Now, this is a comprehensive slide, and I'm not expecting you to read all of this. You'll see at the bottom, Thailand is mentioned. This is taken from the Double Taxation Digest. It's the treaties of digest between the UK and the other countries around the world. And the next slide, you'll see a bit more information about Thailand. It's enlarged and exposed. So what's interesting about the double taxation treaty between the UK and Thailand is the specific articles or lacks of article being applied to pension income. And this is related to pension income because we are talking about retirement income going into Thailand in particular during the course of this webinar. So what's interesting, and you'll see there on the right hand side, you'll see 1, 2, 3, 4, and you'll see that the section 4 says the treaty does not include articles related to non-government pensions. And number 1 as well, which talks about relief may be restricted if not all of the income is remitted to Thailand. Now, as almost like a caveat in addition to that, this number 3 below that talks about the convention in respect of income from sources within the UK. That's allowed as a credit against Thai tax if one were paying Thai tax in respect of the income coming from the UK. But the credit itself can't exceed that which will be applicable to Thai tax kind of before any credit is given. So what that's basically saying, to summarize that, is that if one were trying to use the double taxation treaty to lose UK income tax being applied at source to UK pensions into Thailand, it would be quite difficult, and it would mean that a full disclosure of that level of income will be required. And having dealt with individuals in Thailand for the last 14 years, it's rare that one has got the requirement to do so in terms of disclosing all of overseas sources of income. But it does depend on the type of visa that one has and how their stay is determined in Thailand. And having done so much work with individuals on this, the general consensus and the general viewpoint is, and it's easy to look at the equivalent of HMRC websites in Thailand itself, so the local revenue authorities, you'll notice there that with a basic retirement visa, they are interested to tax overseas income if it's remitted into the country during the course of the Thai tax year, which is the calendar year, as you probably know. So what all of this means is that if one has UK pensions in payment, anything other than the state pension, what this will mean is that if one tried to get tax in the UK exempted from that income, it would be difficult. And you can see this here where it's mentioned. You'll see that it talks about contracting state or a political subdivision or any local authority. Now, summarising A and B there, basically what it means is that it would be feasible to have a double taxation agreement enacted on UK pension income for a Thai resident if one has a civil service pension. So this is not referring to the basic state pension, it's referring to civil pensions, teachers' pensions, superannuation, NHS, those kind of pensions. If one has income from one of those sources, and that person would have to become a Thai citizen as well. So in the just under 14 years that I've been working with individuals in Thailand, I'm yet to see someone who has both of those attributes in one, i.e. a civil service pension and has also become a Thai citizen. We do have a few clients who become Thai citizens, but we've never seen those two paired together. So in terms of enacting a double taxation agreement, it's difficult, it's tough, which means that normally pensions paid from the UK, that's a company pension, personal pension type of arrangement, paid from the UK will be subject to tax in the UK unless those conditions apply. So what we're looking at here is ways of reducing tax on UK pension income, which is not easy. There is this, which is an official part of the HMRC rulebook. You'll see the clause, it's ITE PA03. That would ordinarily charge occupational pensions to UK income tax. That's the clause, the part of PAYE regulations. And what that means is that UK pensions are treated as earned income in the UK. So for someone that's employed, the treatment of the pension they would receive will be exactly the same as that employee on their normal earnings. However, there is this special exemption, and this is quite rare that people actually know this, being that we provide tax advice to individuals in the UK, and for those Brits outside the UK or those that have some form of UK source of income, we need to know these things. A few times I've come across people in Thailand where they've had an occupational pension. They were completely unaware of this. With some tax work, we were able to get the tax taken from that pension to be taxed locally or not taxed in Thailand if it wasn't remitted to the country within the Thai tax year. So how does it work? Very simply, there's a criteria there, and it's quite straightforward. This applies to defined benefit pensions, those old-fashioned type of final salary pensions. That's important to say that it does apply to the old-fashioned. Those with an accrual rate, i.e. 1/60th for every year of service, 1/80th for every year of service, those guaranteed pensions in payment. It applies to those, and quite simply, if the last 10 years service of when an individual was a member of the pension, they were abroad, or it's half of the total service during the time they were a member of the pension scheme and covered at least 10 of the last 20 years. So this 10 years is important, but it's common that we've met people that have either gone to the end of their career or through into retirement, and they've had a pension many years ago of that old-fashioned defined benefit occupational pensions where they're not aware of this position. And with some simple tax work, we've managed to get these paid gross to be taxed in Thailand if their income is remitted during the course of the Thai tax year. And if not, if it's kept offshore and perhaps cash is brought in from time to time, it's taxed from the UK. There is no tax applied in the UK, which means it's gross, which means it's very effective and still guaranteed and probably inflation proofed. So that's another method of exempting tax on UK pension income, in particular, as I say, that defined benefit, the old-fashioned final salary income. Now, this is a term that I'm sure you've heard of over the years. This was introduced a year after I moved to Singapore. So in the UK, there was this significant moment in time for pensions, which was called Aid A, and that was in 2006. And the year after, QROPs began to grow their own life, began to grow their own existence. And even so far, what was happening was there were pensions that were introduced in Singapore and all different countries around the world that were being used and being effective to transfers into these pensions by typically British subjects, British citizens who had UK pension entitlement. So that marketplace developed really 2007, and because I was already in Singapore, It was fairly safe to say that we began at the start of this whole arena, these QRUPs, these qualifying recognised overseas pension schemes. So we saw them change, we saw them develop, and what we did see was lots of intervention and interference from HMRC, because I don't think they understood the flow of pensions being moved out of the UK, because prior to the introduction of these vehicles, it was difficult to move a pension out of the UK to overseas. There was much more qualification required, and having been involved in this industry for 31 years, we saw this prior to this change. So back in the early days, Guernsey was a very popular destination for moving pensions to. And what was very appealing about that was because there was no tax at source in Guernsey, and the local tax treatment was dependent on where one was based. When HMRC realised that this seemed too good to be true, and it really was a case that no one was receiving any tax revenue, whether that was HMRC or the location of where the pension was, they thought, oh, this is not appropriate, so we're going to change this. So then Gibraltar was the second most popular destination after Guernsey was altered and tinkered with, and really that remains to this day the only real vehicle that actually works. It has a fixed 2.5% income tax at source, and where we've used these because they are the right thing to do, which is not always the case, but where we have used them, and we have a number of people in Thailand with the Gibraltar option, and where there is a reasonably large level of pension income, it's far more effective because of the restrictions with double taxation agreements as mentioned. So they can, or they certainly could, provide more favourable income tax treatment if the pension fund was large enough. Primarily, the personal allowance had been used up in the UK, and it left some with exposure to UK income tax. That by transferring a pension overseas, we could reduce that. We've also seen Malta used for some people in Thailand. We've come across these people who've had this arrangement put in place for them, which was odd because when it was put in place, there was no double taxation agreement between Thailand and Malta, which was the place where these QRUPs were established that were used for certain people, which meant that typically, in the absence of a double taxation agreement, not being like the Guernsey vehicles or the Gibraltar vehicles, there was a chance that there was more income tax being paid at source, 35% in Malta, than may have even been the case actually if it was kept in the UK. So we've seen lots of these cases where we've become involved. We've tried to soften the blow and change things, and it is possible to do so. But realistically, what's happened to QRUPs? There has been a significant change which came into force just over 4 years ago now. So further tinkering from HMRC was designed to almost quash these apart from specific official reasons, and it's now possible to transfer to a QRUPs without being penalised. You'll see on that slide a 25% tax charge is mentioned, only if the individual and the pensioner are in the same country, or both are within the European Economic Area, or the QRUPs product itself, the pension plan itself, is provided by the individual's employer. So most of those don't apply, or certainly the main ones of those don't apply to anyone in Thailand. It's unlikely there'll be an active QRUPs marketplace in Thailand, in my opinion. So it's probably safe to say that it's very difficult to think about these as being a way to reduce UK income tax on pensions in the future in the current guise and the current format. We can't believe that HMRC will mess with these even further. We don't think there's anything else they can do, and which was a shame, because in the right circumstances, and certainly for the individuals where we have used these, they've been very effective in reducing the tax burden that may otherwise apply to UK pensions in payment. So there are also provisions that if one moves a QRUPs to another location for 5 UK tax years following the transfer, those provisions may still apply, and it could be a transfer charge. So it's very important to say you have to tread very lightly with these cases, and it's case-by-case basis. Now, this is the second subject, and what we're looking at there is the way of holding investments. This has developed over the years, not to say that the first variation is being used effectively, although my daughter may argue differently. What we're looking at here is a way of holding investments. And going back some years, and as I mentioned earlier, I've been in this industry for 31 years, 32 years very soon. If we go back a number of decades, this was the way that people were holding investments if they weren't using a broker or some kind of discretionary manager. And this was a way of buying investment funds historically, because those platforms, those kind of technology didn't really exist a decade or 2 decades or 3 decades ago. Having been in the UK until 14 years ago, I saw the development of the platform industry in the UK, and it really did change things. Prior to which, people bought direct funds, and some of the terminology in the UK, which you'll be familiar with, unit trusts. OICs is the current version of that, which is open-ended investment company. Mutual funds as we know them overseas, or Luxembourg CCAVs. And historically, what that would mean would be quite clunky dealing, normally paper applications, and to sell and buy investments, it could be done by paper, but by telephone, but would normally have to be followed up with some form of paper. The charges on these things were historically between some zero, normally index trackers, but that was rare, up to about 5.25%, which typically provided this advisor commission, as it was known back then, of about 3%. And the charges ongoing were somewhere between sort of 0.75% up to about 2% a year for global managed equity funds. And that also typically included an amount for servicing for the advisors that were arranging these products. Broad marketplace, as you would know today, with stocks and shares and bonds and alternative investment funds. And there was lots of these available, but because it was quite a slow process, much more inflexible than what we see these days, things are developed for the benefit of, I think, investors and also for advisors. Now, this is something more for an individual to use, and there are a number of companies around the world that offer these. There are a few companies that do offer these into Thailand that we're aware of, quite big names as well. And what they do is they allow investments to be purchased, whether that's direct securities, stocks and bonds, or whether collective investments, those funds, to be purchased. There may be some country-specific conditions. As you may or may not know, Thailand is classified as a tier 2 country. So this does mean enhanced due diligence is required on the ground. There is obviously sort of some aspect of financial crime over the years, which has brought this to people's attention and the governing bodies of countries and financial institutions. So it does make things a little bit harder to get a range of investments and products in Thailand, as well as many of the other tier 2 countries. But they are a cheap way of buying investments. It normally allows access to most listed investments on the main global exchanges. There can be some limitations on currency and also the type of asset that one can buy, but they're normally offered by quite large companies. So if they're actually offering products into Thailand itself, it's going to be normally adequate for most people, because you can buy stocks and shares and bonds or collective investment funds through these. With the limitations are that they are normally execution only, which means that no advice is provided. They are just an account to literally to buy and sell investments through. There are a few hybrid companies who do offer those with some basic advice, but typically that kind of account will be an execution only product. It's not something that most of the companies like us do. That's fairly safe to say that we don't really offer these kind of things to those individuals that we work with, but they are a viable option if one has the need to purchase investments themselves. Now, this is used more commonly. It's known as a general investment account. In the UK, it's probably the most common method of the way individuals hold investments in the UK is through this kind of product. And it is a product, but it's very, very simple. It's just an account that allows you to buy some individual securities, but primarily investment funds, whether that's index trackers or managed funds, very wide ranging in the UK. It's almost every kind of investment company allows these type of investments to be purchased through these platforms. Lots of major providers in the UK, including Fidelity Funds Network, Celestia going back some years, Transact, Nucleus. There's many companies in the UK that are offering these, but there's not many companies in the UK that will allow investment for non-UK residents. And I mentioned Fidelity as one example because we've had some clients that have had Fidelity Funds funds network, the supermarkets, if you like, these platforms in the past, and they've been quite distinct Fidelity to say that they are not allowing changes or not even allowing new monies into the existing accounts. So it's a great product, it really is, and it's good for us as an advisory company, and it's good for the clients that are in it, because typically it's a competitive marketplace these days, so the charges are cost efficient, quite trimmed down, and I've quoted there sort of 0.5% per annum, but we use some that are a lot cheaper than this. It's rare because they are used by advisory companies. We don't offer any kind of execution only advice at all. We don't offer any products that allow execution only. We're an advisory company, so if we use these, which we do very, very regularly, it's for full advice. Now this, I can quote some companies, and I'm not saying these companies are good or bad, but Royal London 360, Quilter International, there's many companies out there that offer these kind of products. They're a life assurance based holding method, used very extensively in this part of the world. It tends to be the sort of default. If someone wants to invest some money, it ends up in one of these. They're good because they offer a very wide range of currencies and most listed investments. For a UK resident, they're more complicated because they're a tax deferral mechanism rather than being tax-free. But for people that are offshore that use these products, they can be quite tax efficient because there is no tax at source, and dependent on the treatment of using these in somewhere like Thailand, there may not be tax to pay on them. The downside with them is that they, and I say they, the companies that offer these products, and I quote many names, including those kind of companies, AXA, Friends Provident International, Royal London 360, Quilter International, they do have a slightly wide menu, and often that menu is misused by the so-called advisors that provide advice on these. So it ends up being an expensive product when it may not need to be so expensive, which often means that there are penalties for moving away from these products in the early years. So the surrender penalties being equivalent to a form of initial commission for the advisors. So they're not a bad product on the surface. It's just how they tend to be abused over the years, which has led to them having let's say a weaker reputation accordingly. What they can be useful for is for trust planning, because a lot of these providers have their own offshore trust companies, which means that the trust company itself should stay around for the life of the arrangement. So they have a place, certainly it's just where we've seen them used. Often they've been misused, which is a shame, because I think if they have the capability to be okay. Now this is, it's a service, if you like, and typically discretionary portfolio management has been the preserve of those higher net worth, the institutional investors, the charities, because most of the companies that offer this kind of arrangement have high minimums. $1 million is common, $1 million currency equivalents, and many companies much higher. We can get forms of this at lower levels, but it's few and far between. They tend to be higher levels, particularly in Singapore. I mean, the levels are really quite high. But what it means is that the money is invested in an agreement, a parameters established at outset, and then the decisions are made by the fund investment houses, ongoing without reference to the individual themselves. So it's managed in a format to suit the original parameters put in place. And they are cost efficient, and they tend to be the same sort of cost as having a portfolio of funds, for instance, available in most currencies. And there can be some restrictions on countries. Again, I mentioned that enhanced due diligence earlier, particularly sort of tier 2 countries upwards, a bit like Thailand. There can be some restrictions, but they're a useful proposition because at the right levels of investment, they tend to be very good, nice, cautious investment, which are cost efficient as well. So with all of these things, it's difficult to say there is one right solution for individuals, because there are many different options and almost a variation on a theme. This is a style of investment management as opposed to being a holding method, but this is the flip side of discretionary portfolio management, which is where ongoing investment decisions are made, recommendations are made, but they have to be agreed by the investor themselves. So there are no decisions made without reference to the individual who holds these investments themselves. As a result, it can be a little bit slower than discretionary because this agreement must be sought, but it does allow investment at lower levels. But they will typically be using investment funds as opposed to direct securities as a result. And lots of this is based on economies of scale anyway. But because of that, most holding methods can be used, those referred to in the previous few slides. In terms of cost, it's very similar to what one would pay for discretionary portfolio management. But what tends to evolve from that kind of investment method is close relationships between the investment advisor, the advisors themselves, and the actual individual, the client themselves. So close relationships are formed, and different products can be used, which can be even more efficient than discretionary portfolio management. But typically, we'll see levels at the same, costs are the same. And the outcome can be very, very similar. For those with the right levels of investment assets, they can be a useful option. That's discretionary and advisory, which is a method of investing. So that's it for me for the moment. I will come back to you towards the end, and we'll take a few questions. And in the meantime, I'm going to hand you on to Max from Schroders for an update on investments.
Thank you very much, Martin, and good evening, everyone. Thank you for your time and for tuning in. My name is Max White, and I am investment advisor and portfolio manager at Schroders in Singapore. We have a wealth management office in Singapore, as we do in a number of different jurisdictions, the UK, the Channel Islands, and Switzerland. And we're the wealth management division of Schroders, the asset manager, which is FTSE listed and family owned. So I'm just going to give you a brief 15 minutes or so on the investment outlook, as Martin thought that would be useful for you all, and we thank Martin and the Fry Group for their inclusion of us in the webinar. So what I wanted to do was to move on to the sort of the overall outlook, and to talk about three things. The initial sort of segment will look at the global economy and our sort of view on where we are at the moment. Obviously, last year was a pretty traumatic year in terms of investments, although by the end of the year that they did turn out to be pretty good in terms of returns, and I think most clients were happy. Portfolios performed pretty well. I also want to go through sort of the risks for the individual investments, and how we sort of view things are in terms of positioning. Then I want to move on to the future, so to speak, and looking at which areas we believe will be important for growth in portfolios and for our clients over the next sort of 5 to 10 years, which is typically the outlook that we look at for portfolio management and for investing in certainly in the riskier assets. And then the last section will be our views and positioning, which is important. I'll give you an overview as to how we sort of view things at the moment, and how they will look going forward. So I'm just going to move on to the first slide. Just bear with me.
Max, can you share your screen for us, please, so we can see the presentation?
Yes, just bear with me. Can you see it now?
Yeah, we just want to make it full screen in the slideshow setting for us.
Yes, I will do that. Yeah, so you'll see on this slide an overview of where we see things in terms of 4 main areas. So the economic backdrop, valuation, so how expensive the investments are that we're looking at and investing in, or potentially can invest in. Then looking at sentiment, which is essentially, how bullish or bearish, as they say in our industry, the investors are at the moment, and that has important implications in terms of the direction of price. And then looking at risks, as I said to you before, there are a number of risks out there that we have to keep an eye on, as you'd imagine. So the first one, looking at economics, and we've seen quite a rebound in global growth, as you'd imagine, which we'll look at in the next slide. But looking at a low base from 2020, when everything fell off a cliff from around March time, it's a strong and encouraging rebound back. And central to that will be the reopening of economies, and a lot of future performance and growth is dependent on that. So we'll look into that a little bit later as well. On the valuation side, the main asset classes that we look at, the main types of investments, are equities, which give you your growth and are known as risk assets, as well as bonds, both government and corporate. And these are largely expensive. Certainly the government bond side is very expensive, but we do feel that there are pockets of value which remain. And again, that's really our job to find those opportunities, but it's just important to be mindful of that. Sentiment is generally based around the fact that things are rebounding, so that's a positive. But then at the same time, a lot of it is based around low interest rates. So as you'll be aware, interest rates are low, they have never been lower, and a lot of what is priced into the market in terms of the sentiment is that they will remain low. And so this is a risk. And we also need to just sort of keep an eye on the language that comes out of the central banks, like the Bank of England, like the US Central Bank, the Federal Reserve, as to when those interest rates might move up. And then lastly, looking at risks, and we'll look at this in a little bit as well, it's really centered around inflation, and when we might see interest rates being increased in order to try to combat or to counter inflation. And this is a major concern and consideration for investors and central bankers. Now, this slide will give you a little bit of an overview as to what happened last year in terms of global gross domestic product. So GDP, as they call it, was crashed globally by almost 4%. Now, we clearly see a lot of that coming back in 2021, and it will remain as a rebound element of 2022 as well. But we have to keep a close eye on that, and we also have to work out the best ways to combat to take advantage of it. Importantly, you'll see that in 2008, 2009, when we saw the Great Recession, as they call it, there was a large, what was considered then a large move down, which was sort of dwarfed by last year. But there was one main difference, or two, I suppose, between the two. So back in 2009, 2008, 2009, there was a big problem with the banking system, with credit, with an overheating, with many problems, which inevitably can't be solved overnight. Now, in 2020, there was a big problem, that was COVID-19, and vaccinations can bring that back into line a lot quicker, as long as the damage and the scarring doesn't go on for too long. So I would point to that in terms of the difference this time around, but that's not designed to belittle the issues that we have now, or the consequences of last year. Moving swiftly on to this slide, which looks at corporate earnings, so the companies making money in the market, in everyday business, their business as usual. And you'll see that 2020 was obviously a dire time for corporate earnings. Now, 2021 is already showing to be a big bounce back, and 2022 2 looks pretty good. And this is relevant really for the equities or the risk assets in your portfolios, because the risk assets are driven by earnings. So when you buy shares in a company, it is driven by the earnings that those companies post. They will drive the stock price up or down. So this earnings outlook needs to remain positive in order to, and we need to see increased and positive company earnings, and that will translate into, or should translate into, good performance in stock markets. Now, I talked about liquidity earlier, and when I talk about liquidity, I mean the money sloshing around in the system, either in terms of the interest rates being at rock bottom for from central banks, but also the savings that have been built up in our savings account, the consumer savings account, because of lockdown, because of the lack of opportunity to spend. This is a really important factor, and it does, as it says here, remain supportive. So it would indicate that things will be pretty positive for company earnings, for the economy, for a rebound, for a sort of a mini boom, if you like, over the next 1 or 2 years. Hard to see much further than that. And that is something which, again, is pretty supportive of equities, and it will mean increased spending as consumers spend down some of those savings that they've made. Again, looking at equities, we've seen quite a lot of talk about how certain stocks have gone up and certain stocks have perhaps not gone up as much as others. And the ones that have gone up a lot have been the growth orientated names. So the likes of, we've all used Amazon, I'm sure, and the online shopping providers. And we look at companies like Google, Facebook. Those are the internet names, but equally the sort of the growth-focused stay-at-home names as well. For example, home improvement companies, etc., have gone up, and there's a lot of optimism around growth. But the value names, which are perhaps less glamorous and include the likes of energy companies, etc., as well as, to a point, until fairly recently, raw materials and commodities, they have not done anywhere near as well. And a lot of that is based around what you'd call the focus around companies that have good growth prospects and will be doing well in going now as well as going forward. Now that differential in value, as you can see, has hit a record high, sorry. So growth stocks are very much loved, and value stocks are very much sort of unloved. Now it's changed a little bit, and they've become a little bit more loved, but this is a good example of how we can look for opportunities in our portfolios and in the investment landscape by essentially selling the expensive and buying the cheap. Now, I'm going to move on in the interest of time quickly to talking about the main risk as we see it, and that really is the return of inflation, because all of this activity could certainly bring back inflation, and that would cause interest rates to move up. In fact, a lot of the activity is clearly, as you can see from this slide, motivated by or generated through the vaccine, and this is talking about the anti-vaccine movement. But I think generally that vaccine movement doesn't have a lot of traction in the UK and perhaps the US as well, which seems to be coming out of this quite quickly. Now, just to cover off the other two themes relatively quickly, we look at important sort of future drivers of growth. And as you can see here, we've just outlined 5 of them. And just to very quickly run through, clearly technology has changed the way that we live, and some of this will reverse when things normalize, but I think at the moment it's fair to say that it will be it will still have a lasting impact, and digitization has been accelerated dramatically. Healthcare is another area which we look to invest in companies that are able to generate a return through rising healthcare spend and costs and a generally aging population. Then we look at the likes of China and other emerging and growing markets, and China is now, really on the cusp from a financial and investment point of view, becoming more and more important, and increasingly takes a role in our portfolios. Government debt is something that we have to be mindful of after the events of the last year or so, and so we can take advantage of this through various infrastructure funds, which are very important from a sort of for governments to secure future revenues in order to offset and to service their debt. And then lastly, but certainly not least, looking at sustainable and energy transition themes, which are very close to Schroders' area of focus, and we very much believe in having a purpose and a mission in our investments, and clients find this very, very important. And then just lastly, having a look at where we stand in terms of the different investment arenas, or different asset classes as we call them. And we've now got to a stage where we are overweight equities, which means that we have more equities in terms of proportion in portfolios than would be the long-term average. And as I said before, it says here in this slide, potential for future value outperformance. And these are these unloved stocks which are sort of coming back, and we feel are interesting. We don't have a lot of exposure to government bonds, which traditionally are the ballast in the portfolios, and that's really because they're very expensive, and we don't believe in buying expensive assets. We just don't get paid for it. And then looking at alternative asset classes which are exemplified, or an example of them are alternative infrastructure assets, such as, for example, toll roads, other government projects that need finance, and will pay investors a revenue stream going forward. And then lastly, we like to have some cash just in case we need to put money into the market. And then, the longer term themes, which I touched on before, technology is driving a lot of things, and while we have to be careful not to get carried away by technology, and we don't want to pay too much for investments, we have to be on that tide. And a lot of that overlaps with China as well, because of the demographics there. Important trends such as the Internet of Things and smart cities are very prevalent in China and Asia in general. And then really just looking at areas like infrastructure, as well as overlapping that to green initiatives which focus on ecology and doing good in the environment. Again, increasingly essential to our strategy. So I think my time is up, but hopefully that's sort of given you a bit of an overview in terms of the markets. And I think that there might be some questions hopefully later, and maybe I can expand on certain elements with the extra time in the Q&A session. So thank you for that. Yes.
Keep your video mic on, Max, because the questions are next, and there's a couple of questions for you. So if you keep on your,
Sure.
I'll take over the screen, but other than that. Okay, so thanks, Max. As I say, there's a couple of questions which I'll fire to you in a moment. We've got a handful of these. We've probably got sort of 10 minutes or so we can probably get away with if we can just cover some of these. While you're on, first question is, and you covered some of this, but do you think the question was, do you think that the vaccination program is going to be the main effect on broad investment markets in the short term, do you think?
Yes, I think that the market is definitely looking, so investors in general are looking at the vaccination program, and they're watching it closely. I think that there's been a lot of good progress, particularly so the UK has progressed well, as we know. Europe is perhaps a little bit behind, and the US is doing quite well in addition to that. And I think that if you look at those markets, particularly the US is the main driver of markets and sentiment. It's still the biggest market and the most liquid. And if the vaccination program goes well, then it is a massive stimulus because, as I said before, the spending will come from the savings of individuals who've been locked down. That will feed through into the economy through increased leisure options, retail, and obviously the consumer, whether it's through retail or through various leisure, is something like 75% of the US economy. So that will have a massive stimulus and a massive effect. And that will drive corporate earnings, and those corporate earnings will then be a positive boost for stock markets. So it's really important that we continue in this way. But at the same time, it's important that I think that these vaccinations are deemed to hold against the new variants, which at the moment, it would appear that they are.
Thank you. While I've got you, a couple of other quick questions, if I may. Do you think the question was quite sort of straightforward? Is there any sort of main political issues that perhaps are known or not known in the short-term future? Anything sort of politically coming up? Because there's been a few things over the last year or two, but most of those have been and gone. Do you think there's anything coming up?
Well, I think so. The US perhaps not, because they've had their, as you say, it's been and gone, and they seem to be on a fairly decent trajectory now. If you look at the UK again, they've had their problems, and they just need to get this vaccination and economic numbers up, and that'll be, I think, generally a good space to be. I think Europe is one to watch because I believe it's next year. There will be elections in Germany, and Germany is clearly the focal point of the EU, and the EU relies on Germany and France to have a good relationship and to hold the whole show together. And I think that if you see massive changes, it looks like there will be in Germany. It'll be interesting to see how that works then with Macron and the relationship. And, if you also see that Britain, as I believe, and I certainly hope is the case, coming out of Brexit stronger and better and fighting hard and innovating, then that can't be great for the EU. So I think keep an eye on the EU, but for the moment, Europe is in a pretty good place, as it's come from a bad place. The vaccines being rolled out, or so we believe, and so will increasingly be rolled out. And actually, a lot of people are quite positive on Europe. In terms of other areas, other geographies, I mean, the big elephant in the room is obviously China, and the relationship that China has with the rest of the world, and with in particular the US. But I think that really the main negative or risk around that is trade, rather than China and the US being in a sort of a fractious relationship. Now, clearly, as long as it doesn't lead to significant conflict, that's perhaps less important. Trade is the big one.
Last quick question, then I'll just cover a couple of quick ones myself. The question was quite simple in terms of, it was very short, the question, but after developed world, and in terms of portfolio construction, and I do lots of this and you do lots of this, but in terms of portfolio construction after developed world, and the US being a big part of that, emerging markets, Asia Pacific, or both as an inclusion in portfolio?
Well, yeah, so emerging markets are important to us, and we have an inclusion in our portfolios. As you'd imagine, that's where the growth is, albeit at a high level of volatility. We would definitely favour Asia over the rest of the emerging markets, and obviously Asia overlaps into emerging markets. Some years ago, we had to stop looking at emerging markets as a sort of homogenous group, because clearly they aren't, and they weren't probably even back then. And Asia is really our favorite area for a number of reasons. Asia's actually suffered a little bit in the last couple of months, and that's because of the lack of progress on vaccination. And the variants seem to have got through a lot more effectively into these sort of isolated countries than the old strains. So that's forcing them to rethink here. But hopefully, with additional supply of vaccine, Asia can move out of this. And I would say that we would definitely favour them. And actually, they're a bit cheaper now. So that's probably an opportunity.
Wonderful. Thank you, Max. Just a couple of other quick questions. One of the questions was I have a friend who seemed to acquire, this is a question for me, seemed to acquire a zero tax code on their pension income very easily. I've heard this once or twice. The best answer I can have is HMRC would normally say, if you're speaking to the right person, not just a call center individual, if you're speaking to the right person and you said, I'd like to get my UK pension income tax exempted, they would say, on what grounds? On what grounds? I.e., is it double taxation agreement, or is it their occupational pension service exemption, the overseas pension exemption? It's not as straightforward as just calling up HMRC and saying, look, I live elsewhere, even though this is a UK source of income, I'd like to get it tax-free. But that's the best answer. It's always worth looking at individually. And I think that's almost a mistake where we've seen those cases before, just the individual in HMRC not looking at this closely enough. Last question, very quickly. One of the questions was, what's the main difference in the trading account that you mentioned earlier and a German investment account? Quite simply, I guess, is the advice aspect. One could have a trading account and buy stocks and shares and funds themselves directly, most likely without any advice. If you're talking to an advisor, an investment advisor, and they're using a German investment account, it will come hand in hand, which is advice. So that's the main difference. No more questions. In terms of contact, these are our details. We have the main Fry Group website, which links into other websites, but go to that if you would like to get in touch with us. Follow us on LinkedIn as well, or we have the distinct advice at email address. So if you'd like to get in touch with us to discuss further, those are the main ways of doing it. You'll find us if you search the Fry Group, of course. And realistically, thank you for attending. We hope you found this useful. We do try to change the topics and the subject matters regularly, but we